Millionaires mentor millionaires. And over the last 9 years, I've made millions in the crypto market. And I've also lost millions too. And had there been a video like this one when I first got started in crypto over 9 years ago, I'd have saved well over 8 figures, dodged scams, hacks, rug pulls, and made way more money. So in today's video, I'm handing you my battle-tested playbook with 10 lessons to make more money in 2025's bull run and lose less money, with Bitcoin making a new all-time high and altcoins like Aster exploding to nearly a $4 billion market cap in just a week. We're about to dive deep. My name is Nick Anderson, founder of altcoinpro.com and owner of Bull Runners, and I've assembled the smartest minds in crypto to create the gold standard in crypto education for people that are just getting started in the industry or intermediate investors and traders that are looking to take their game to the next level. So these aren't just textbook tips. You're getting my millionaire blueprint for free to bookmark for your crypto journey. So we're going to hit mindset. We're going to talk about the top pro tools and resources to maximize your upside while minimizing your downside during the bear market. So comment 777 if you're feeling bullish, if you're feeling blessed, and if you're in this for the long haul. And also comment below how long you've been in the crypto market. And if you're going to become the first millionaire in your family tree, confirm it by tapping the subscribe button. Let's run it. All right, bull runners, welcome back to the channel. So if you're brand new here, we talk about crypto every single day. So just make sure you're subscribed for daily alpha in the market. That way you can stay in the know. Throughout the course of this entire video, we're going to cover the top 10 lessons from my 9 years in crypto to help you go from where you're at right now to your first million. Or if you've already made millions, to help you take your game to the next level with some nuanced points that virtually nobody's talking about. So we're going to talk about market cycles, psychology, and different pro tools to help you build generational wealth. Now, as always, quick disclaimer, none of what I say is financial advice. Crypto is risky. You could lose everything. And by even watching this video and taking action on this information, you accept full responsibility for your own financial decisions. And if you lose money, you obviously understand that's your own fault. I'm not making any guarantees here. And any examples that I give are real, they're documented, but they're not a guarantee that you're going to produce the same results. So as always, do your own research, go consult a financial advisor, because the truth of the matter is crypto is very difficult. It's not easy. If it was easy, everyone would do it. And over the last 9 years, I've had to learn the hard way. Yes, I've made a lot of money, but I've lost so much money in the process. And my goal by the end of this video is to help you compress timeframes so you can take my nearly decade worth of experience and compress it down to a year, arguably even less, depending on how coachable you are. So let's dive right in with lesson number 1. The 4-year market cycle theory isn't gospel. A lot of new investors come into the market and they hear about the Bitcoin halving and the Bitcoin 4-year market cycle theory. And this provides a loose framework for how market cycles work, because Bitcoin is currently 528 days past its last halving at the time of making this video, which occurred on April 19th of 2024. And when analyzing the history of previous cycles, we noticed a slight variation in the number of days between each halving and their respective all-time highs. In 2012, it was 371 days. In 2016, it was 525 days. And in 2020, it was 546 days after Bitcoin's halving that it reached its all-time high. So the subtle trend of lengthening suggests that we're in the final stages of the current cycle right now, which aligns strongly with other fractal and market cycle metrics, such as the fractal cycle and the max intersect SMA, both of which also point to an imminent top. Now, if Bitcoin were to reach 548 days post-halving, that would land exactly on October 19th, just a few days from right now. And hypothetically, if Bitcoin were to extend to 561 days, that would place the top on November 1st of this year. And considering if the 4-year cycles remain consistent, then we're at most 30 days or less away from the price peak of this cycle. And October has historically been a very positive month for crypto. And if we use the seasonality indicator here on TradingView to get access to this, it's very, very simple. I'll leave a link in the description below to create your free TradingView account. At the top, you'll see where it says indicators. You simply click this. You type in seasonality. It'll be this indicator right here. As soon as you click it, it'll pull up these dates at the bottom of the screen that basically show the historical performance of Bitcoin every single month from its inception. You'll see that October is historically bullish for Bitcoin, on average performing 21% to the upside. So a lot of people wonder, what's the real driver of Bitcoin and the crypto market, aside from the Bitcoin 4-year market cycle halving theory? Because if historically Bitcoin has done well in October, well, one of the most important indicators that I use to track macro market cycles is global liquidity. So to access the global liquidity indicator, you do the same thing. You click indicators, you type in M2, and M2 Global Liquidity Index by MIK3 Christ will pop up right here. You just click it. and it'll be at the bottom of the screen. Now, you can take your mouse, click it and hold on this little yellow chart right here and drag it onto the price chart, and it'll overlay it with Bitcoin's price chart or any other cryptocurrency that you want. So if I just turn off the seasonality indicator, we can see Bitcoin's price action right here, and we can see the M2 Global Liquidity Index right here. Now, simply put, M2 Global Liquidity refers to the sum of money supply from major economies like the US, China, Eurozone, and Japan converted to US dollars to provide a single measure of global cash and readily convertible assets available for spending and investing. So it serves as the key indicator of overall available capital in the global economy, influencing inflation, interest rates, and the price of risk assets such as cryptocurrencies. It's basically the total money supply within a country's economy here. So it includes M1 money supply, which is physical currencies, checking accounts, savings accounts, money market accounts, CDs, and other short-term easily convertible savings vehicles. Now, as this chart here in yellow, the M2 chart goes up, that simply means there's more money sloshing around the system to invest into risk-on assets. Now, we can pair this up with the Bitcoin price chart, and we can see how this plays out, even going back to the bear market of each market cycle. You can see when Bitcoin topped out back here in November of 2021, well, global liquidity continued a little bit higher after that. But on March of 2022, global liquidity topped out at pretty much the exact same time that Bitcoin formed this complacency stage rally and then saw a collapse to the bear market low alongside global liquidity retreating. Then you can see right here at the beginning of November, global liquidity bottomed out and Bitcoin bottomed out shortly after that. And then global liquidity expanded massively. And that was the start of the Bitcoin bull run because Bitcoin broke out from $15,000 to $16,000 all the way up to $30,000. And as you can see at the top of the screen, global liquidity pulled back again and Bitcoin pulled back and went sideways. Then global liquidity expanded again and so did Bitcoin. So this is one of the most important indicators that you can use to track macro market cycles. And because Bitcoin's historical top has been different for every single bull market peak, well then this bull market peak will be different in terms of days after Bitcoin's halving than the previous cycle tops. If you look at the 2017 high for Bitcoin, as global liquidity pulled back, so did the Bitcoin price chart to the bear market low. Even going back to the 2013 high, Bitcoin topped out, and as global liquidity pulled back, Bitcoin's chart pulled back to the bear market low as well. So the basic 4-year market cycle theory based on Bitcoin's halving often fails because people that are teaching that ignore the broader economic M2 liquidity cycle. And as global liquidity is rising, Bitcoin lags by about 3 months, with a statistical model pointing to Bitcoin's top by the tail end of this year or by early 2026 if the trend holds. So you can see this pullback right here in global liquidity was followed by a pullback right here in Bitcoin's price chart. And then as global liquidity broke out and made a new all-time high, Bitcoin is now breaking out and making a new all-time high. So we need to watch global liquidity very closely because if global liquidity in yellow continues higher, then it's very likely that even with a short-term pullback for Bitcoin, Bitcoin is likely to continue higher by the tail end of this year. Now, I'm not going to lie to you and say here that you're early in this market cycle because you're pretty much entering at the tail end. And depending on what happens with global liquidity over the next few weeks will really determine what's going to happen with altcoins as we get into the rest of this video. So back in 2016 to 2018, I bet big on this crypto bull market cycle. And I held through this entire top for Bitcoin and altcoins, not even realizing that Bitcoin was going to follow global liquidity to the bear market bottom. And I watched my portfolio drop over 80 to 90%. And my business went south too early 2019. So I had to sell all of my crypto all the way down here and then watch Bitcoin and the rest of the crypto market take off while I was left sidelined watching this 2019 rally. And that was extremely frustrating. But I had to learn the hard way, which is why I'm making this video today. Because after COVID hit and we saw this drastic crash in Bitcoin's price, if you look at the global liquidity chart, you can see global liquidity expanded rapidly on out of here alongside Bitcoin's price chart. So by October of 2020, when Bitcoin was around $10,000, that's when I went all in with crypto. And when the markets broke out, global liquidity expanded, the CARES Act was signed into law, and stimulus checks went out there to tons of Americans alongside low interest rates and the Federal Reserve adding to their balance sheet. So it was the perfect storm of opportunity for this bull run. So this is why tracking global liquidity is so important. So you can also go to the St. Louis Federal Reserve database here, and you can track different data points and look at liquidity for central bank liquidity swaps, other liquidity deposits, you name it. And you also want to track the effective federal funds rate because as the Federal Reserve lowers interest rates, it basically means overnight loans with banks are cheaper and risk on assets become more attractive. So for this bear market cycle, you do not want to get caught holding crypto while global liquidity retreats. And in order to better understand when the potential top will come in, this leads me into lesson number 2. Follow trends early using price action. So during a crypto bull run that we've been in ever since early 2023 to today, how you play these market cycles is by following the market's momentum using price action to buy the dips during an uptrend. And then during a bear market is to sell retracements during a downtrend. And then when we're going through choppy ranges where the price is fluctuating between a key resistance and a support, like what happened here for Bitcoin between the 13th of March of 2024 until the 5th of November for 237 days, Bitcoin's price did virtually nothing. This is when you earn yield on your crypto. Now, the biggest mistake that people make is they don't understand price action with key indicators and they end up buying these rallies like this. An example would be accumulating Bitcoin on the 14th of March for $73,000, and they dump in all of their capital from their bank account, and then they watch Bitcoin fluctuate and drop 31% and just range between support and resistance for months on end. So let's say, for example, you put in $10,000 right here when Bitcoin was at $73,000. Well, 150 days later, 5 months from when you bought, your same $10,000 would have been worth $7,000. So if you have 10K or more in crypto, you're literally giving up an extra $300 per month in passive income. You're giving up on a free 3 to 8% additional monthly yield just because it's sitting on an exchange like Coinbase or Binance and you're being lazy. You're taught to hodl, just wait for price appreciation, and this is costing you thousands of dollars. So let's see what happens here. While your assets are sitting there doing absolutely nothing and inflation is kicking your ass. For example, Ethereum didn't do anything over the course of 3 months. XRP didn't do anything over a whole year. And Solana, same thing. It didn't do anything for an even longer period of time while you sat there making no money. And I'm not saying that these are bad investments. It's quite the opposite, actually. But the smartest investors in the world make their crypto work for them to generate additional yield. And why would you not do that? You're holding these crypto assets anyways. It's like buying a rental property and not renting it out. If you hold on to the property because you believe that it's going to appreciate in value over years, why wouldn't you rent it out so someone else can pay your mortgage while you still get the value appreciation? So it makes no sense to just hold your crypto without earning yield on your idle coins. And if you're just holding your crypto on exchanges like Coinbase, your assets aren't safe. In fact, Coinbase was hacked for $400 million and the hackers bribed Coinbase employees so they could access sensitive user information, demanding a $20 million ransom from Coinbase, which the company refused to pay.
I want to make you aware of a disturbing email that we received recently at Coinbase. It was a ransom note demanding $20 million in Bitcoin in exchange for these attackers not releasing some information they claim to have obtained on our customers. I'm going to respond publicly to these attackers by saying no. We are not going to pay your ransom.
And I even received a letter in the mail saying that my information was included in that hack. So I'm speaking from firsthand experience here, not just an article that I read online. So not only are you leaving free money on the table by not earning yield on your idle crypto, but you're also putting yourself at risk of losing it all, getting hacked, or having your account frozen by keeping your crypto on centralized exchanges. Because if it's not your keys, it's not your crypto. You already know this, so I don't have to tell you. You can't afford to be lazy with your capital. The US is drowning in nearly $40 trillion in debt, so this is your insurance against the system. To learn how you can earn passive income on your coins every single day while protecting your capital from hacks or scammers, my research team put together a step-by-step tutorial for you to start earning yield on your crypto today, and it takes less than 10 minutes to get set up. All you need to do is go to altcoinpro.com after you're done watching this video, create your account, and click on the Start Here lesson under the classroom, and you'll discover how one liquidity pool is earning our members up to 40% yield on digital assets that they already own. Plus, you can go into the DeFi yield picks and see even more opportunities to earn passive income on your coins safe and predictably with complete control and ownership of your assets. You will make significantly more money by being your own bank. And all you need to do is go to altcoinpro.com to get started right now. So rather than watching your portfolio lose $3K, which is $3,000 over the course of this period of time, the smartest move is to earn yield while we range sideways. And a lot of people will tell you to just buy low and sell high, or even worse, buy the dips during a bear market and then the price just keeps on dipping. For example, when Bitcoin topped out here in 2017, I was holding everything that I bought prior to that major rally. And I made an even bigger mistake. That mistake was listening to the idiots that told me to back up the truck for the dip. So when Bitcoin dipped, I bought these dips and I got excited when I saw the price rally back again. For example, when I would buy back in at like $12,500 and Bitcoin would rally up to $17,000, I didn't understand the psychology of a market cycle, which I'm going to put up on the screen right here, and realizing that this stage in the market cycle was the complacency stage, and the emotions that I was feeling at that time was the complacency stage high, thinking that we just need to cool off for the next rally, and I got the dip, so the markets were just going to continue higher. But boy, was I wrong, because Bitcoin then crashed from that point another 66%. And if you bought Bitcoin at $12,700, you would have been down 50+% on your purchase, thinking that we were still in the bull market, not studying liquidity cycles. Now, let's say you bought that dip, let's say you bought this dip right here, and this dip right here. Well, 317 days later, you would have been down another 50% on your purchases. So this is why it's super important to follow the trends early by studying price action. And you can also pair this with this simple moving average by typing in SMA, and it'll say moving average simple right here. You just click it once, and then you click it twice. And then the upper left-hand corner, you want to adjust the settings. So on one of the simple moving averages, click on settings. Under inputs, type in 200. And then under style, change this color to blue. Click OK. On the other moving average, click on settings. On inputs, put 50. And then under style, change the color to red. Click OK. So what you've just added is you've added the 200 moving average and the 50 moving average. And we want to track Bitcoin's price action alongside these moving averages to look for things called golden crosses or death crosses. Now, the death cross is when a shorter moving average like the 50 moving average in red crosses below a longer time frame moving average like the 200 in blue. And so for an example of a death cross would be right here on the 8th of April of 2014. We can see Bitcoin pulled back from the high and experienced a bounce back to the 200 moving average and then got rejected from it to continue down to the bear market low. And then once the bear market low was in, we went through this whole entire accumulation phase down here for Bitcoin, which is where you would earn yield on your crypto because Bitcoin just simply fluctuated between resistance and support, doing nothing for about 300 days. So for almost a year, about 10 months, you would have been earning yield down here until you see some strength in Bitcoin's price chart and until you see what's called a golden cross. Now, you don't want to just buy into golden crosses because as you can see right here, the 50 moving average crossed back above the 200 moving average on the 13th of July, and Bitcoin rallied into that golden cross, then sold off even further to the downside. Then we experienced another death cross down here, and after Bitcoin found this second low and price started to make a recovery on out of here, we experienced the next golden cross. But pairing this golden cross right here with the price action of Bitcoin breaking this key neckline and resistance and back testing it as support right here while also using the 50 moving average as support was a sign that we are about to go into a massive uptrend for the bull market because we experienced a major trend reversal. And a trend reversal is just simply a higher high, which Bitcoin experienced by November of 2015, rallying up to $500 than the previous high, and a higher low. Bitcoin was also using the previous high as support on top of the 50 moving average for a macro trend reversal. So then Bitcoin consolidated after that breakout while also forming higher lows on top of the 200 moving average. And then the rest of that bull run, Bitcoin stayed on average above the 200 and the 50 the majority of the bull run. There were these temporary periods where, price would sell off below the 50 moving average, which is normal during a bull market, but we stayed on top of the 200 moving average that entire bull run until Bitcoin dropped drastically below the 50 moving average by January of 2018 and attempted to reclaim it but failed by March of 2018. Also, we saw the 50 moving average in red turning back around to intersect the 200 moving average for a death cross right here by the 30th of March of 2018. And then as you can see during the bear market, the price would use the 200 moving average as resistance while also forming lower highs in this downtrend in lower and then eventually equal lows until Bitcoin finally capitulated all the way down here around $3,000. Now, it was pretty much the exact same thing from 2018 to 2020, although it was more exaggerated because of the DeFi summer right here. But Bitcoin just pretty much ranged between resistance and support until Bitcoin finally broke out after October of 2020. We cleared this resistance right here. And as you can see, it wasn't until after this golden cross where the 50 moving average in red crossed above the 200 moving average in blue. And then the price stayed on top of the 50 moving average and the 200 moving average all the way up until we broke the 50 moving average on April of 2021. We attempted to reclaim it, we failed, and then we dropped below the 200 moving average. Now, this was the major warning sign. A lot of people thought, and arguably so, that the bull run was done at this point and we were just going to rally back up and then sell off further to the downside, which is a fair assessment based on this death cross right here and how in the 2017 bull run, when we experienced a death cross, after this major sell-off, the complacency stage high was a rally back up to try and reclaim the 200 moving average in blue, which as you can see here back in 2017 is the exact same thing that happened we broke down below the 50 moving average in red. We even broke below the 200 moving average in blue, just like on the left-hand side of the screen. We broke below the 50 moving average in red and the 200 moving average in blue. And then once Bitcoin found this bottom, after rallying back into the death cross, Bitcoin attempted to rally after the death cross and got rejected right here by May of 2018 from the 200 moving average, and then went into the bear market using the 200 moving average as resistance. Whereas in 2017, when Bitcoin rallied back up to the 200 moving average right here by August of 2021, similar to what happened back here in May of 2018, well, that was the major sign that the bull run was over, and using price action to verify that would confirm. However, Bitcoin decided to see a last and final hurrah before the bear market started, faking a lot of people out. So this high for Bitcoin, up nearly almost to $70,000, was actually the complacency stage high, whereas the true technical high was in April of 2021, which aligns with the December 2017 high. And this rally right here for Bitcoin by July of 2018 is like the rally that took place by November of 2021, although it was bigger for Bitcoin. So there are going to be some differences in terms of what the price chart looks like and how aggressive these relief rallies are during the complacency stage of the psychology of a market cycle. But right now, if we look at Bitcoin's price chart, we can see Bitcoin at $122,000. It is currently above the 50 moving average in red, and it is above the 200 moving average in blue. So we haven't yet experienced a death cross like what we saw happen here in June of 2021 or January of 2022 since April of this year. We did experience a death cross here. We did experience a death cross back here. So in my opinion, just based on the data that I'm seeing, the next death cross is the end of the bull run because we've already experienced two. And in 2021, we experienced one death cross. The second one, it was lights out. So because we've already experienced two, the third one has a high probability that it would be lights out for this bull run cycle after Bitcoin experiences its peak. Now, it doesn't mean that when Bitcoin tops out, it just goes straight down forever. We do experience these relief rallies here, like we experienced back in 2021 to the 200 moving average, and in 2018 as well on the way down. And so this is the sign that the bull run is really over when Bitcoin fails to reclaim the 200 moving average. Whereas this cycle around, there's been a lot of bear traps. And a bear trap is simply when price comes back up to try and reclaim the 200 moving average, a lot of bears step in and think that price is going to continue down, similar to what happened back here during the bear market of 2018. But then price reverses back to the upside, faking out all the bears, stopping them out of their leverage short positions, and then price continues to the upside. So we saw that happen right here from October and November of 2024. We also saw that happen right here in April of 2025, where price didn't reject from the 200 moving average after this death cross, and it just continued higher. So it's kind of like a double pump fake here, where the next time that this happens, and price drops below the 50 moving average while the 200 moving average crosses above it, and then we see a rally back into these moving averages. Well, the real question people want to know is, will that be a third pump fake for the price to continue higher? Or will that be lights out in the final curtain call for us to finally go into a bear market sell-off? I personally believe that this is what's coming. It's going to catch a lot of people off guard because of what happened right here and what happened right here. New investors are going to think, well, surely it happened twice, so it's going to happen again, especially after what we went through in the 2021 bull run on this double top right here. Do not get caught in the trap thinking that this is going to continue forever. Now, the next lesson is to plan your taxes out before the gains hit your portfolio to preserve your wealth. Because throughout the entire bull run, if you've been trading cryptocurrencies and swapping between Bitcoin, Ethereum, XRP, you name it, well, every single sell, every single swap, even staking your crypto to earn passive income triggers capital gains taxes. And depending on how much money you've made trading crypto, well, according to the IRS.gov, back in 2024 for single taxpayer, 2025's data is probably pretty similar, but the tax rate on taxable income can go upwards of 37% if you're making over $609,000. Now, according to taxfoundation.org here, in terms of state individual income tax rates and brackets for 2025, well, this sheet right here shows the state tax bracket depending on where you live. Now, I live in Florida, so that's a zero state tax, which is awesome. But if you live in a state like California, your income could be taxed an additional 13% if you end up making $1 million or more. And even states like Oregon is an additional 9.9%, Washington is 7%, New York is 10%, Hawaii is 11%. So on top of the tax that you're paying on a federal level, with the top tax remaining at 37% for individual taxpayers with income greater than $600,000, and if you're married, that's $751,000, filing jointly, well, living in California paying an additional 13%, that's 50% of your capital gains, completely cutting your wealth in half. So if you make $1 million and you think you're a millionaire, Well, if you don't plan for taxes properly, then half of your income, that's $500,000, can get taken from you. Plus, if you don't know the difference between short-term and long-term capital gains tax, well, short-term can be taxed anywhere from 10 to 37% of ordinary income. Long-term capital gains could be anywhere from up to 20% after 1 year. If, let's say, you bought XRP back here in November of 2024, and let's say you were to sell it in like January of 2026, wherever XRP's price is at, well, then that's long-term capital gains tax on your gain. So if you're doing a lot of crypto trading and you have poor tax planning, it can lead to massive IRS audits, penalties up to 25%, and fumbling generational wealth. So pre-planning with strategies like setting up a crypto Roth IRA to minimize your liability, which allows for tax-free growth on contributions up to $7,000 per year. And the biggest mistake that I made back in 2020 when I went all in the crypto market between October, November, and December when Bitcoin was breaking out was not setting up my crypto Roth IRA. So when the IRS hit me with an audit for 2022, during the entire bear market, it took nearly a year of going back and forth with the IRS, sending them bank statements, receipts, even subpoenaing the exchange that leaked my information to hackers, Coinbase, causing a mountain of busy work for me, let alone the stress that came with it. I mean, that's why I wear a hat a lot. I got some hairs that have fallen out over this. But had I traded inside of a crypto Roth IRA, rather than just a regular Coinbase account or a crypto.com account, those same buys, sells, and swaps between altcoins wouldn't have the same short-term capital gains tax rules applied. So, do you love crypto, but are you worried about taxes shrinking your retirement nest egg? Here's the deal. Trading and selling crypto can trigger capital gains taxes eating into your wealth. A crypto IRA fixes that. Per IRS publication 590B, traditional IRA gains like those from crypto aren't taxed until distributed. That's why we've partnered with iTrust Capital, a leading crypto IRA company in the USA, to sponsor today's video. And they offer institutional grade custody for retail clients that want to set up their crypto IRAs for retirement, leveraging top storage solutions like Fidelity, Wells Fargo, and Coinbase Prime to keep your assets secure. To get started, simply click the link in the description of this video, sign up for free, and fund your account with cash. They also offer 401k rollovers or crypto transfers, and you can trade 24/7 with just 1% transaction fees and no maintenance costs. As always, I'm not a CPA or financial advisor, so consult one for tax advice, and we do earn a commission if you sign up using our link below to fund your crypto IRA account, but that helps support value-based videos like this. And iTrust Capital already has over 200,000 crypto IRA accounts and over $14 billion in transactions, proving they're trusted by smart investors just like you. So click the link below, get started now by funding your account today, and let's create generational wealth together. So you'll see in the description of this video the link that says start your crypto IRA account here. As soon as you click that, you'll see that we teamed up with iTrust Capital to offer new clients an exclusive $100 funding bonus. So then you just simply click see promo code, it'll scroll down here, and then you sign up to get started. And I also made an entire video about this concept titled How Much XRP Do You Need to Retire Early?, where I show you step by step, click by click, exactly in the back office how to set up your crypto Roth IRA account. So I'll leave a link for that in the description of today's video. So make sure you check that out after this one. And just by going through our link, you get an additional $100 funding bonus. So if you live in states like California, Oregon, New York, Minnesota, even Idaho, South Carolina, Georgia, Alabama, Mississippi, basically any state that has over a 5% state tax, or you've made any amount of money in crypto, this is the most important thing that you need to do right now. Now, lesson number 4 is to measure your portfolio in Bitcoin terms, not US dollar terms, because you already know that the US national debt is nearing in on $40 trillion. And if in 2010 you purchased an item for $1, well then in this year, that same item would cost $1.49, which is a cumulative rate of inflation of nearly 50%. It gets even worse the more that you zoom out. Over the course of 25 years, you've lost 88% of your spending power. So why would you measure a crypto asset that you hold to the US dollar when the US dollar has been going down in value? The smartest thing that you can possibly do is measure it relative to Bitcoin, to reveal the true performance here, and also to understand when trend reversals will take place. Because the US dollar prices of a crypto asset can mask underperformance when Bitcoin outpaces altcoins, as Bitcoin is the crypto benchmark and is the largest market cap cryptocurrency. So this is going to help beginners avoid holding altcoins that bleed relative to Bitcoin. So the first step to do this is to understand the Bitcoin dominance price chart. Now, at the top of the screen, you can see Bitcoin's dominance here that shows what percentage on the right-hand side right here Bitcoin holds of the whole entire industry. So right now, if you go to coinmarketcap.com, you can see in the upper left-hand corner, the market cap of the entire industry is roughly $4.19 trillion. Now, Bitcoin's market cap is $2.44 trillion, meaning Bitcoin holds 59% of the whole entire industry. So there's periods where Bitcoin's dominance outperforms everything else and altcoins bleed relative to Bitcoin. Then there's also periods like what happened back here after January 2021, where Bitcoin's dominance goes down relative to altcoins, or after March of 2017, when Bitcoin's dominance goes down relative to altcoins. So since June of this year, Bitcoin's dominance has gone down relative to altcoins from 66%, and now we're sitting just shy of 60%. So we've dropped a little over 6% over the past few months. And in the upper right-hand screen, if you have a pro account at TradingView, now this does cost money. If you want to take trading and investing in crypto seriously, I highly suggest getting a pro account. Again, I'll leave a link in the description below to sign up for free, and then you just simply upgrade your account. But you can click on Layout Setup here, and you can add multiple charts side by side to compare them to each other. And this is what we need to do to understand how certain altcoins in our portfolio are performing relative to Bitcoin. So we're going to click underneath number 2, this chart layout right here, where they're both stacked on top of each other. And when I click on the bottom of the screen, I want to select total 2. In the upper left-hand corner where you see the symbol search, you just type in total 2. It's the crypto total market cap excluding Bitcoin. So we click on this, it'll open up the chart. And on the left-hand side of the screen where the tools are, you can click on trend line. You can also click on vertical line right here. And you want to place a vertical line at each peak for Bitcoin's dominance here at the top of the screen. And on the bottom of the screen, you can see how this cursor moves on both screens at the same time to pair it up to know where altcoins were at the exact same time. Now you can zoom in and out, so you're going to have to take a little bit of time to move this. So for the sake of time of editing this video, I've already done that for you. Now back here in March of 2017, Bitcoin's dominance was upwards of 90+%, like 96%, whereas altcoins were down here at $800 million in market cap. When Bitcoin's dominance dropped, that's when altcoins went on that parabolic bull run leading into the top of January of 2018. So although Bitcoin still did well going to the peak, altcoins did better after Bitcoin's dominance peaked out. Now also back here in December 2020, Bitcoin's dominance was upwards of 73%. Altcoins were right here at about $190 billion. Once altcoins broke out, we went on that bull run while Bitcoin's dominance dropped. And so this time around, altcoins are right at their previous high that they were at back here in November of 2021, but yet Bitcoin's dominance is still upwards of 50, almost 60% now. And I've been talking about this in previous videos about how Bitcoin goes through these periods during altcoin bull runs where we see these initial sell-offs and then we see these short-term temporary relief rallies, which Bitcoin is going through right now, which is why, Bitcoin is upwards of $122,000. And even Bitcoin made an all-time high like yesterday while I was prepping for this video, all the way up here above $125,000. So as Bitcoin continuously trends higher and absorbs liquidity from the market, well, then Bitcoin's dominance will go higher. Now, that doesn't mean that altcoins will do bad, because if we pair this chart up on the right-hand side of the screen with Total 2's chart, well, we can see that altcoins have been rallying since the 7th of April, but since recently, since the 8th of September, with Bitcoin's dominance rallying up, altcoins haven't really done that much. They've just kind of gone a little bit up. So Bitcoin is just outperforming altcoins. So as Bitcoin's dominance goes up, it doesn't mean that altcoins go down. It just means altcoins can still go up, but less than Bitcoin. So this is really good for the whole entire industry. We want to see Bitcoin's dominance go up as Bitcoin's price chart goes up, and we want to see altcoins do one of two things. We want to see them either go sideways or go up while Bitcoin's dominance goes up, and that means new liquidity is coming into the market, which is why the market cap of the whole entire industry is now starting to grow again. Because on coinmarketcap.com, you can click on the market cap and it'll take you to this chart right here, and it shows you where we're at. Over the past year, ever since August 13th, we've been ranging between $4.1 trillion and $3.7 trillion. And now we're just right barely above that August high 3 months later. And so during a ranging period like this, that's when you earn yield. And now that we're breaking out, we could be going through a whole industry liquidity injection, like I just mentioned, like we went through November to December of 2024, when you saw the market cap go from $2.5 trillion upwards of $3.7 trillion. So this would lead us up to and beyond $5 trillion for the whole entire industry. So an actionable tip that you can apply when looking at any chart, for example, if you want to look at Ethereum's chart right here, you don't just look at Ethereum compared to the US dollar. So when you click on the symbol, ETH to USD is what most people do. Instead, what we want to do is ETH to BTC, or you want to do, like XRP to BTC. So if we're looking at ETH to BTC, this chart right here on Binance is probably one of the main ones because Binance is the largest exchange. We click it, it loads up Ethereum's performance to Bitcoin. Now, as you can see, if we also pair up ETH to Bitcoin compared to the Bitcoin dominance chart, you can see right here at the top of the screen, ever since Bitcoin's dominance bottomed out here at around 39%, that's when Ethereum compared to Bitcoin topped out. And so then Bitcoin's dominance experienced a major trend reversal. And like I just mentioned at the start of this video, a trend reversal is when we clear a previous high from a downtrend and we put in a new series of higher highs and higher lows. So when Bitcoin's dominance broke out from this low all the way up here to 52%, we put in a higher high than the 48% high right here, which is the neckline like I showed you on Bitcoin's price chart. Then we came back down to back test it as support to put in higher lows, and then we were off to the races there, putting in higher highs and higher lows this entire bull market cycle for Bitcoin's dominance, whereas Ethereum then started to put in lower highs and lower lows. And so by the time Ethereum was all the way down here compared to Bitcoin, we were back at the previous support levels that we were at all the way back here in 2019. So this was a major sign that Ethereum's rally was due because Ethereum had been underperforming Bitcoin pretty much the whole entire bull market until April of 2025, whereas Bitcoin's dominance has been outperforming Ethereum. So just looking at the ETH to Bitcoin price chart compared to the Bitcoin dominance chart, what do we see here? Well, we see that just recently, Bitcoin's dominance has pulled back from 66% and it's been in a downtrend, whereas Ethereum to Bitcoin has been in an uptrend. Now, I talked about this in another video where I expected Ethereum to break out back to its all-time high after we cleared this high, and that's exactly what happened. Now, what I'm expecting, if we just clear the charts here, is I'm expecting a short-term pullback for Ethereum relative to Bitcoin because we've already experienced this major rally. So once Ethereum to Bitcoin's downtrend is done and Bitcoin's dominance uptrend is done, I would expect a further rotation back to the downside for Bitcoin, causing Ethereum to have a blow-off top. Now, when this will happen, we will see. I mean, it could happen in the next 1 month, 2 months, 3 months, but this will only happen for Ethereum and all altcoins once Bitcoin's dominance is finished with this relief rally and rolls over back to the downside. So you can do this on any price chart, but Ethereum's the main one, and you're going to see, even if I do it on XRP to Bitcoin's price chart, it plays out pretty similarly because Ethereum had a rally, XRP had a rally as well, and now we're just cooling off for a little bit on the XRP to Bitcoin's price chart while Bitcoin has its day in the sun, because Bitcoin has been ranging between $123,000 to $109,000 ever since August of this year. So for the past 3 months, Bitcoin hasn't done much, and now Bitcoin starts to break out. I would most likely expect XRP to Bitcoin's price chart to underperform, and then Ethereum to Bitcoin's price chart to underperform as well too. Then once Bitcoin's dominance is done rallying, I would expect there to be a spring to the upside for altcoins to go parabolic at the tail end of this bull run. So during downtrends like this, it's smarter to hold Bitcoin, and then after Bitcoin's dominance has finished its rally, it's smarter to hold altcoins on the next breakdown. Now, how do you know when the breakdown is going to happen? Well, you can use Confluence. We talk about this inside of Altcoin Pro University. Again, you can click the link in the description below, go into the classroom right here, go through the Technical Analysis Essentials course. There's like 28 videos that teach you everything you need to know to understand price action. You can also go to the calendar here, attend any one of our weekly calls. The Technical Analysis Tuesday one is incredible. We also have guest speakers that attend these calls. Now, for the sake of time in this video, I can't go into every little detail, otherwise this video would be about 12 hours long. But we can also use key indicators like the Relative Strength Index and the Stochastic RSI. And you can see here on the weekly chart, we've been in oversold territory during this downtrend for Bitcoin. And also the RSI has come back down to about 30 and is now experiencing a reversal back to the upside. So we'll see how much higher Bitcoin's dominance goes in the short term. But Bitcoin is building up pressure here, and eventually I would expect the dominance to make a major move to the upside to come back up closer to 60% or even 61%, maybe higher. So while this happens, then just expect alt to Bitcoin pairs to experience a short-term pullback. But compared to the US dollar, like I just mentioned, that means altcoins could either go sideways or they could go up, but Bitcoin just goes up more. Now, lesson number 5 is to master the trading view basics for support and resistance. Listen, you don't need complex technical analysis to succeed. Learning basic support and resistance levels using TradingView can help you spot value zones for buying low and selling high during uptrends, and also protect you to stay out of the market during downtrends while you earn passive yield until the market is bottomed out. Because support and resistance levels will show you where price tends to bounce at support. For example, when Bitcoin finished this downtrend during the bear market and found a bottom right here, well, on this major reversal for Bitcoin, you can see that it faced some resistance on the way up. One resistance was right here at about $25,000, which was the previous high. It acted as resistance right here. And then once it flipped it and formed a new high, it acted as support right here on the 16th, 17th of June, and also on the 11th and 12th of September. And it even went sideways on this support for a while before breaking higher. So if you understand how to draw support and resistance levels, then you can know how to spot macro trend reversals like this, where we put in higher highs and higher lows than the previous highs and the previous lows, to spot macro trend reversals to where now we're going into a bull market. And then on the other side of the equation, during a bear market, you know when not to enter into the market, buying into major resistance levels that were support. For example, when the price chart broke down here from $48,000 all the way to $25,000 and rallied back up into this zone right here, well, this was a zone of support ever since 2021. So thinking that this is the dip in the market is not smart, because it's actually now resistance since it flipped support. And then we continue to the downside. Now, during a bull market, we've seen this stair-stepper price action for Bitcoin, where Bitcoin breaks out. We see this aggressive rally from the bear market low. We consolidate on top of the previous resistance as support. We go sideways on this stair right here, and we use it as the next step to go higher. And sometimes price action comes down to backtest it. Sometimes it doesn't, because it's so parabolic of a move that the dip is much higher than the previous resistance. But a good percentage of the time, and a general rule to go by, is looking at these levels right here as good entry points during an uptrend. Because if you were to just draw the peaks, you can see a large majority of the time when Bitcoin would break out from a previous resistance, it would consolidate for a while, and then it would always come back down close to it or bounce off of it as support before breaking out all the way up here again, and then coming back down again, bouncing off of it as support. And what happened just recently? Well, Bitcoin broke all the way out up here, upwards of 123, almost 125K. You can see the previous high all the way back here from December of 2024. Well, what happened? Well, Bitcoin sold right back off into that once, and then twice used it as support. And now Bitcoin is bouncing back to the upside. So if we just draw the resistance again for where Bitcoin's at right now, once Bitcoin makes the next major move up, this would most likely act as the next level to come back down to as support. So now that you understand the bare bone basics of this, it doesn't need to be complicated. During an uptrend, the best time to accumulate is when we come back down to previous resistances as support, to accumulate as much as you possibly can. And had you have done that this entire bull run, you would have had 1, 2, 3, 4, 5, 6, 7 opportunities on the way up to accumulate these dips. Now, you can also pair this with indicators like the stochastic RSI, the relative strength index, the MACD, moving averages, you name it. But this is a major key to use more than any other indicators, because price action is what all the pros use. The indicators can just add confluence to your decisions. Now, the next lesson is to borrow against your crypto. Don't sell it. Because I made a video right here talking about how you should never sell your XRP. You use it to become your own bank, explaining crypto lending. It got about 77,000 views on Twitter. I'll also leave a link in the description for this video below. It's 22 minutes long, and it goes way more in detail than I'll go through in this segment right here. But like I just mentioned in lesson 3, to have a tax strategy, this also applies to it, because for 2025, the tax rate remains 37% for individual taxpayers. Well, that's short-term capital gains tax. Now, long-term is a little bit different, and depending on where you live is going to determine how much you're paying by state. So this unorthodox strategy used by investors like Michael Saylor can avoid massive tax hits on short-term capital gains and keep you in the game. And it's best to apply this strategy after an altcoin or a cryptocurrency has experienced a major sell-off and it starts to make a reversal back to the upside, so you have lower risk of liquidation. So you need a good understanding of what I talked about in lesson 2, understanding the trends. But if you've been in the crypto market for a while, maybe you've heard of this concept, but you don't know how to get started. Well, listen to this. Have you built a crypto portfolio over $1 million, but want to access your wealth without selling any of your coins? Well, imagine unlocking up to 85% of your portfolio's value to fund ventures like real estate, to buy other projects in the crypto space that are undervalued compared to the projects that you currently hold, or to diversify into different DeFi yield opportunities. That way you can live on the interest without selling any of your crypto. Well, we've partnered with a leading global office offering non-recourse crypto loans for investors with portfolios starting at $1 million. The same company that is trusted by the world's largest institutions and investors, because as you already know, the billionaires don't sell their crypto, they borrow against it. So if you're ready to unlock up to 85% of your portfolio's value without selling any of your coins and you have a portfolio with at least $1 million, then email us at team@bullrunners.com. You're going to see our email contact in the description below, and we'll get you connected with the company that has helped clients like ours north of $100 million borrow against their crypto without selling any of it. Now, if you don't have at least 7 figures that you're looking to borrow against, then this strategy might not be for you. It's mostly for people that have at least 7 figures they're looking to borrow against. So feel free to skip to less than 7 if that's not you. But if it is you and you want to learn more about this, then watch the 22-minute video that I put here on x.com. It explains this in more detail on how to become your own bank by borrowing against capital, then using DeFi liquidity pools and these strategies that our research team at Altcoin Pro teaches to be able to maximize your results. Again, the link for that will be in the description below this video. Now, lesson number 7 is to concentrate your bets. Avoid over-diversification into too many coins because diversification is the key to preservation, but concentration is the key to wealth creation. And if you don't have generational wealth yet and you don't have millions of dollars in crypto, then concentration is how you scale your wealth faster and also maintain your sanity during a bull run, because if you have too many coins that you're holding on to, it becomes virtually impossible to track all of these. I mean, look at coinmarketcap.com and scroll down here to the bottom. You're going to see 95 different pages of coins. So there's millions of cryptocurrencies to choose from. And over diversifying your portfolio spreads you too thin, making it impossible to just track all these coins. And it kills your upside when Bitcoin starts outperforming, because some of these lower cap projects that are sub $100 million market caps drop 80 to 90% when Bitcoin pulls back, sometimes 20 to 30%. So during the entire bull run, you want to be focusing on the large cap projects until really the tail end of the bull run, where the smartest investors focus roughly 80% of their portfolio on the top 1 to 3 leading narratives. So CoinMarketCap just gives you those narratives. When you click on more, you can see real-world asset protocols, artificial intelligence, and memes tend to be really hot. Now, memes have become diluted this bull run, and you really need to know what you're looking for memes. So the top narratives are going to be artificial intelligence and real-world assets. Now, if you just focus on those two, that's all you need. Arguably, you could focus on one and become a master of one. Like, you could focus on the real-world asset projects. You could focus on the artificial intelligence projects. Because if you're managing too many different coins across too many different narratives, it's going to give you decision fatigue. That's why people like Mark Zuckerberg, when he wakes up during the day, he puts on a gray t-shirt so he doesn't have to make too many decisions, burning out his willpower. And if you have to make too many decisions on what coins you should sell or rotate, then you experience the capital gains tax, and rotating all your capital into another coin on a breakout is how you just get wrecked. So if you're just chasing Bitcoin on the breakout and you're rotating your altcoin into Bitcoin, and then Bitcoin starts to sell off, and then we see altcoin pairs pump, once Bitcoin really breaches into price discovery, then altcoins start to catch up to Bitcoin. Well, you don't want to be chasing these pumps or rotating your capital from a coin that might be down here and put it into something that's up here, selling at a loss pretty much, and then buying into a peak. So it makes sense to pick the winners early. Because since we're talking about the mistakes that I've made here throughout the course of this video, one of the biggest mistakes I made was on the way up here, I accumulated like 20 different cryptocurrencies across every possible narrative. Whenever an influencer would talk about a cryptocurrency, I would buy it. And I couldn't keep up with all of it. So I got analysis paralysis by the time that the top came in and we were at the complacency stage high. I didn't want to sell anything because I was so overwhelmed on what to do because I had too many coins in my portfolio. I had to juggle 20 different projects. And because the market moves so rapidly, it would have been tough to liquidate them all that quickly because of how many buttons I would have to click. And because I was juggling altcoins at this phase in the market cycle, well, it only took 1 month for these altcoins to drop 70%. So 1 month is a very short time frame to make a decision. And while my portfolio was bleeding out 70%, I was in a panic state and I didn't want to sell anything because I thought surely it would have recovered, when in reality it slowly bled out to the bottom. So when you see your portfolio at an all-time high and it's tempting to take a screenshot and share that with your friends, your family members on how rich you're going to be, but then you see it drop 70% and you're holding 20, 30, 40, 50 altcoins, it becomes even more difficult to sell when you see these retracements take place because you got addicted to what your portfolio was worth up here. Because here's an example. Let's say your portfolio was worth $1 million in January of 2018. Well, when it dropped 70%, it would have been worth about $250,000. And then even though from that dip, it's up 134%, you still would have been down nearly 50%. So right here on this retracement, your portfolio would be worth $500,000. And let's say you put in most of your money right here on the breakout, throwing in $250K. Well, emotionally, it becomes more difficult to sell for $500K because you're like, well, I had $1 million at one point, unrealized gains. So why would I want to sell for a measly 2x right here when I could just wait long term because crypto is going to continue to go up? And then you watch your $500,000 bleed out another 84%, all the way down to the bear market low down here being worth $80,000. And this is a major problem that happened to me because I got so addicted to the unrealized gains at the top of the market. I held too many cryptocurrencies that become impossible to sell because I have decision fatigue when I could have just focused on literally 5 projects or less. So what you want to do if you're watching this video at the bear market low and you're getting value from it thus far, well, for the next bull market cycle, literally pick 1 to max 3 narratives, which I believe artificial intelligence is still going to be popular going into the 2030 bull run. Real world assets are going to be popular. And then for this bull run leading into November, the ISO 222 standard is going to do well, with projects and companies that are ISO compliant. And then literally just diversify 80% of your income into the 3 top projects in that niche. And then you can have 10% of your portfolio to day trade other projects, that might be lower market cap stuff, like new projects launch every single bull run. And you want to have some capital and some dry powder on the sidelines to be able to buy them when they pop up. And then you can have another 10% in DeFi liquidity pools. And then you can just have 10% sitting in your bank account. Now, that's an aggressive strategy, obviously. That's only if you're really serious about crypto, because some people might want to hold more cash in their bank account. That's dependent on what you want to do. I'm not going to tell you how much to keep in your bank account or not. I'm just telling you what a lot of cryptocurrency bulls do. And during bull runs, they're more aggressive. But at these levels right now, as we get closer and closer to the top, if we're not yet at the top already, they get more defensive on the market and they start having more cash on the sideline. So as we get closer to the top, you want to have less in the crypto market. And arguably you want to have like 80% in cash and stable coins and earn yield and APY that'll pay you percentage on the income that you have on the sidelines. And then 20% you can still have in the crypto market and just hedge this out on the way up and on the way down on the other side. So basically you're hedging on the way up to get 80% on the sidelines. And then on the way down, you're pretty much selling the remainder out on these retracements as we crash and bounce up. So if the markets go much higher, then these retracements are going to be, higher than where we're at right now. But if the market doesn't go higher, you don't have 100% of your income still in the market. And depending on how aggressive the move is for some of the altcoins that you hold, for example, Total 2's chart broke out here where some cryptocurrencies led that rally, then you can rebalance your portfolio quarterly, especially if you're trading inside of a crypto Roth IRA, because then if you swap that cryptocurrency in your Roth IRA, it's really tax deferred. Now, if you do want to see what altcoin picks our research team has spotted for the rest of this bull run, go to Altcoin Pro, click on Community, click on More right here at the top of the screen, and you're going to see altcoin picks. And those will be posted as soon as they pop up. Now, lesson number 8 is to use stablecoin yields during a bear market and also to offset loan costs if you participate in crypto lending. So if you watch the video that I made here that's about 20 minutes long, talking about how to become your own bank, using your XRP to borrow against it. Well, if you borrow against it, you're not borrowing in the US dollar. You'd be borrowing in a stablecoin like USDT or USDC. And then you would be applying the DeFi liquidity pool strategies to be able to deposit your stablecoins to earn APY on your income. So like I just mentioned before, in Altcoin Pro University, you can click on the DeFi yield picks. And we teach tons of different strategies like beginner strategies, intermediate, expert strategies. For example, this one right here, where Mo says DeFi isn't just about waiting for a number to go up. You can earn yield while you wait. Think of stablecoin farms as a fountain you won't touch, providing constant stablecoin firepower to deploy into other plays. For example, if you have 10K sitting around, you could be earning 1 to 3K in risk-free capital, though nothing is truly risk-free, obviously, and nothing is guaranteed, of course, disclaimer. But with certain beginner-friendly stablecoin yield farms, like Arbitrum to Base lending USDC, that could be 10% APY, and that's better than Coinbase's 4 or 5% APY. And so why it's great is because it's a set and forget strategy for long-term farming, but it does provide lower yield because it's through a stable coin rather than an altcoin pair. And then if you want to go into the intermediate yield farms, there's higher yield with some risk there. You can earn yields of like 30%. And then if you want to get more extreme and learn the advanced yield strategies, the yield is even higher, but it does require some work there. And that's where the APYs can get absolutely insane. Some of which we've seen 100% APY. Some of them are like 500 to 1000% APY, depending on what blockchain you're doing these yields on. So there's tutorial videos on all of these strategies inside of Altcoin Pro. And you just go underneath the DeFi yield picks here, and you'll see every single strategy imaginable. Now, here's an example. Let's say you had a million XRP right here when XRP was worth $2.20. We'll just draw a 1M here. And let's say you used a conservative 25% LTV, which is loan to value ratio, of your portfolio to borrow against, meaning you would have borrowed $250,000, that's 25%. And the interest on that would be depending on what platform you go through, but let's just use a 10% annual interest as an example. So of that 250K, let's say you take 200,000 of that, you apply an intermediate to an advanced liquidity pool strategy to earn 40% APY, which creates an arbitrage opportunity between the interest on the loan and the liquidity pool strategy of about 30%. And had you not learned how to use stablecoin yields to offset the loan cost, well, that loan cost of that 10% on 250K, would have been about $25K that you would have to pay over the year on your borrowed amount. Well, because you took $200K and you applied a liquidity pool strategy to earn 40%, that ends up coming out to $80,000, so 80K. And so the difference there is 40% minus 10%, so that's 30%. So that's $55,000 extra income earned in yield on 200K. Plus, you forgot that you have an additional 50K that you borrowed on the loan because you only used 200K for the liquidity pool strategy. So that remaining 50K, you could have used that for a real estate deal. Heck, you could have put it back into XRP if you wanted right here, and now it would have been worth an extra 35%. So 50K plus 35% is about 17.5K. So that ends up coming out to $67.5 thousand. And you also still own the $1 million in XRP that is now worth 35% more. So that's worth $1.35 million at where we're at right now at roughly $3. So you still have the 1.35. You also have 67.5. You generated 80K in yield off of 200K. Then you have to pay 25K in the annual interest, leaving you with a difference of 55K. So if we add all that up, that ends up coming out to over $1.7 million. Rather than just holding your income, you would have just had about 1.3, earning an additional $372,500 using a conservative 25% here LTV on your XRP. Now imagine if you got a little more aggressive and you use 50% LTV to borrow 500K using 300 or 400K to earn 40%. Can you see how insane this gets? Plus, if you take that capital and you put it back into XRP or another cryptocurrency, this is how you can increase your exposure to other altcoins without selling any of the XRP that you own, while also borrowing against your capital and earning yield applying arbitrage strategies. So that's the power of borrowing against your crypto that you already hold, so you don't have to sell any of it, using the DeFi liquidity pools and the DeFi yield pick strategies that our research team shares with you, so you can be able to offset the loan costs, earn passive income on your crypto. That's also how you protect yourself against inflation rather than just holding cash. And it's how you protect yourself during a bear market, so you can earn yield the entire way down to have more capital at the bear market bottom to be able to rotate back into the crypto market. Now, this leads me to lesson 9, and that's betting on category leaders, not on copycats or derivatives. Because if you're picking the top narratives, like let's say artificial intelligence or real world asset protocols here, if we go into AI, you're going to see that the top coins in the AI space right now are Near Protocol, BitTensor Tau, and then we got like Story, Internet Computer, Render. So if you were to literally just pick 3, like Near Protocol, BitTensor Tau, Internet Computer, and have 80% of your income in these 3 projects, well, if these 3 projects don't do well, then the rest of the real world asset industry is most likely not going to do well, because the leaders are like the health gauge on the whole entire sector. So that's like if Bitcoin doesn't do well, crypto doesn't do well. If Ethereum's not really doing well, then all of altcoins might not do well. So when the tides rise, so do all ships. But if you're focused on the copycats and the derivatives of these projects, like instead of focusing on Dogecoin, if you bought baby Dogecoin here for a meme coin, well, if you look at the chart here, it's down over 30% still, while other leading large cap projects are outperforming these low cap meme coins. And it's the same thing with the stock market. It's called the Magnificent Seven. You know, you got Nvidia for AI, you got Microsoft, Meta, Google, Amazon, Tesla. You know, had you bought these stocks and then just held them long term, over the course of 5 years, you'd be up 167% on Microsoft, 1,300% Nvidia, then 200, 150. You would have been up on all of these. And even over the past year, you'd be up on all of them. Whereas if you get a little more gambling into copycats or companies that are saying that they're going to put, you know, Microsoft or Apple out of business, well, that's few and far between. And that gets very, very risky. You shouldn't be doing that with a large chunk of your portfolio. You'd maybe be doing that with like 5% or less than 10% of your portfolio to look for companies that can maybe have more growth than a 200%. Now, personally, I wouldn't touch the stock market with a 10-foot pole at these levels. The crypto market has more risk to reward ratio here, but I would still focus on the winners in each of these categories right now until we're at least at the last like month of the bull run, and then having 80% on the sidelines, maybe keeping 10 to 20% still in the market to catch the blow off top that the mid caps and the micro caps will run. So you can use the trending tab for that a little bit later on, but you have to know exactly what to look for. And that's a whole nother video in and of itself. Like I just mentioned, our research team shares with you inside of Altcoin Pro under market updates and the weekly live calls that we have here for our members. But you can use DeFi Llama to check the category leaders, and you can see based on total value locked which chains are experiencing growth each bull run. For example, like Ethereum's total value locked is $94 billion. Solana's total value locked has exploded this bull run. One project right now that is undervalued in price compared to the total value locked is SEI. We can even see Linea has exploded recently. Hyperliquid has taken off. Sui's taken off. So when you spot the total value locked on these chains increasing, like the base chain, for example, then you can look on that chain for the industry disruptors and the leaders on those blockchains that are performing well to just focus on the winners. And this is how our team found Aster. If you look at Aster's total value locked, it exploded from $300 million to over $2 billion now because it's on the Binance Smart Chain. BNB is the 5th largest crypto by market cap. It's the currency of the largest exchange in the world, Binance. It's at $161 billion. So BNB is the centralized exchange token, and Aster is the decentralized exchange token for the BNB chain. Well, Aster is under the DEX narrative. Now, decentralized exchanges is another narrative to focus on. That's where Hyperliquid and Aster are going back and forth. So if you're just diversified across these two, these would be the top performers of the DEX sector. I wouldn't focus on any other ones. I would just focus on Hyperliquid and Aster. And if you look at the total trading volume, well, Aster's trading volume is $109 billion, it looks like, over the past 24 hours. I don't know how accurate this is, but it's dwarfing Hyperliquid right now. And it's a fraction of the market cap with only a $3 billion market cap compared to Hyperliquid, and even the Binance Smart Chain over 100 and something billion dollars. Whereas if you look at Hyperliquid, the market cap of Hyperliquid right now is at $16 billion. So for Aster to just reach half of Hyperliquid, it's a 2 to 3x from here. And when you see a dominant category leader, you're bound to have one other category leaders. It's exactly what happened with Microsoft and Apple. They're two computer companies. I wouldn't consider these copycats. This is like a LeBron and a Kobe. So, well, if Hyperliquid's one of the leaders, well, then Aster would most likely be the Apple to Microsoft example for this bull run cycle. Now, I'm not telling you to buy either of these cryptocurrencies. These are just examples here. And when you know what to look for on chain, you can find the data to position yourself accordingly that our team teaches inside of Altcoin Pro. Now that brings me to lesson 10, and that's planning your exit before we reach the euphoria stage in the psychology of a market cycle. Because arguably, if we're right here in October and then leading into November and then December, we're going to see the top of the market very, very soon. You don't want to be caught exiting the market while you're feeling anxiety, denial, and then panic and capitulation, and then being angry if you have to sell at a loss from when you bought the last year. So as we go into optimism, belief, thrill, and euphoria, you need to set your plan now. Got to have a notebook, write down how you're feeling on a day-to-day basis and track your emotions. That's going to give you a good understanding of where we're at or where you're at based on the cryptocurrency that you're holding, because each of these cryptos go through their own psychology of a market cycle phase at different times depending on when Bitcoin tops out. Some altcoins are going to top out like 30 days after Bitcoin depending on the size of the market cap, and some of them might top out at the same time as Bitcoin if they're larger market cap projects. It just really depends, because most people will think that alt season will last 6 to 8 months, but they're wrong. The smartest investors are going to be fully exiting over the next couple weeks to December here, and there's reasons for that. It's based on cyclical patterns, it's based on global liquidity, it's based on price action, moving averages, top signals that we'll discuss in other videos, and it's been 4 years since the bear market low. So alt season is expected to happen pretty much now leading into November and December. Bitcoin's dominance is on its last retracement rally here, and technical setups are aligning with macro trends, adding momentum to the fire. So the best way to exit the market is not all at once. It's kind of like loading or unloading an airplane. You have to go one row at a time or one group at a time. So that would be a laddering strategy. So for example, while Bitcoin's up at these levels, a lot of people are actually laddering out, anywhere from like 10 to 20% of their portfolio over the next couple of weeks as Bitcoin marches up here to new all-time highs. And let's say Bitcoin breaks out much higher on the next leg up, well, then a lot of investors are going to be laddering out another 10 to 20%. Arguably even more depending on how high Bitcoin goes on this rally. But let's say we get a top in early of 2026 and it causes Bitcoin to blow off top at anywhere between 150 to 180 or 190, and we just go full vertical. Well, then if this starts to happen and you've already taken, let's say 40%, the higher upper echelon of your portfolio out of the market into stable coins, as Bitcoin rallies up to 130 to 140, well then on this parabolic blow off top up here, depending on how high Bitcoin goes, taking another 40 to 50% off the table can't do you wrong, because if you bought all the way, down here at these dips or even the bear market low and you've been holding on to these gains for that long, well, if let's say Bitcoin tops out here and goes into a bear market, well, you've already taken 90% of your portfolio off the table into, stable coins, and you can hedge out the remaining 10% on these retracement rallies while Bitcoin's in a bear market, either all at one time if you want on this retracement rally or slowly but surely on every single retracement on the way down. Because while new investors think we're just going to keep going up forever, the smartest investors in the world are deploying this laddering out strategy where they sell, a portion here, they sell a portion here, they sell the largest portion up here and then having like 10 to 20% left in the market on the way down. There's some nuanced points here because you're going to have a certain amount in your crypto Roth IRA. You can contribute up to $7,000. So if you have way more than $7,000, maybe you're borrowing against some of it and then the remainder you have in a trust, and then some you have as a day trading strategy. It just really depends on your net worth. Again, that's why I don't provide financial advice. Every single person's situation is different. But thinking with the end in mind and planning the exit before we even get to the end is how you protect yourself from scrambling and getting so addicted to the gains that you're going to see on your portfolio on the parabolic blow off top that you never push the sell button, and then you just ride the bear market all the way down to the bottom, losing out on all of these gains that you could have made had you just taken profit.